Very good evening to all my BCA final year students. Let us commence with the subject of COS, that is Computer Oriented Accounting System. Now, in this series of video, we are learning about journal entries under different categories. Last, we learned about bad debts. So, let us discuss about bad debts. Bad debts is an irrecoverable item, or secondly, it is a loss to the business. And bad debts are the amount of money which we have given to others, means the creditors, and they have not returned us the money. So it is a loss to the business. And secondly, bad debts occur or happen due to three reasons. First one is insolvency, when the person is declared insolvent in the court or in the eyes of law. Secondly, it's death, when the person is literally death. And thirdly, it's dishonesty. When a person is dishonest in nature, he does not pay the amount which is given to him. Now, today we'll learn about treatment for bad debts recovered. If the bad debts are recovered after a time or after a tenure, what is the treatment or what is the accounting treatment we need to do? So, firstly, when we recovered an amount from in the previous transaction, we recovered an amount that is in 1 rupee, we recovered 60 paisa. That in 1,000 rupees, we recovered 600 rupees. In 1,000 rupees, we recovered 600 rupees. Okay. So that was the sudden or instant recovery from the person. Now this is when the person, after a few passage of time, when the money is recovered from the bad debt account, it is not transferred to the personal account of the person. Suppose Ram and Sham, Ram has taken rupees 5,000 from us. He has become insolvent and court has ordered to pay him 1,000 rupees. He can pay only 1,000 rupees. So after 1 year, if he is paying 1,000 rupees, then we will not credit that amount to the sham account, but we will credit that amount to bad debt recover account after some passage of time. If it is instantly we are getting the money, then we'll write to personal account, that is sham account. But after a passage of time, we will credit that amount to bad debts recover account, not sham account, not the personal account, but bad debts recover account. For example, Chandini remitted rupees 400 against the amount previously written off as bad debt. It was written off as bad debt means it was already declared as bad debt. The money or the amount of rupees 400 is already declared as bad debt. So written off, the meaning of written off is it's already been declared as bad debt. And again, you got a chance to recover that 400 rupees. So it is been a passage of time after the declaration of bad debt. It's a passage of time. Then you're getting back your money of rupees 400. So the amount, the transaction will be cash account debited rupees 400 to bad debts recover account 400, because the money you're getting, the cash is a real account, debit what comes in, credit what goes account, credit what goes out, and bad debt recover account is an income account, or we can say a gain to the business or the income to the business. So all income and expenditure go on the nominal account. So debit all expenses and losses, credit all incomes and gains. So to bad debts recover account, it is credited. So I'm repeating myself again. Chandini remitted rupees 400 against the amount previously written off as bad debts. Means previously in the books of account that 400 rupees was written off, means written in the accounts as bad debts. But now you're receiving that money. Means it's been a series of time or the passage of time, after a passage of time. So cash account debited rupees 400 to bad debts recover account rupees 400, being bad debts recovered. Moving to the second example, Nadeem, who owed rupees 2,500, is declared insolvent. Only 60% could be recovered from him. So now we are calculating 60% of 25,000. So 60 divided by 100 into 25,000, which equals to 15,000. So cash account debited 15,000, as we are getting only 60%. So we'll write 15,000. Bad debts account debited, the money which you are not getting, that is 10,000 rupees. To Nadeem's account, that is 25,000 rupees. There is a difference between the previous transaction and this transaction. There the amount has been recovered. Here the amount has been declared as bad debts. There is a difference between this transaction and previous transaction. I repeat myself. Nadeem, who owed 25,000 rupees, is declared insolvent. Only 60% could be recovered from him. So 60% of 25,000, that is 60 divided by 100 into 25,000, which equals to 1500. So cash account debited, as cash is a real account, debit what comes in 15,000 rupees. Bad debt account, because you were about to get 25,000 rupees, but you can only get 15,000. So remaining 10,000 rupees is your bad debts. And bad debts account is a loss to the business. So it is a nominal account. So nominal account, the entry is debit all expenses and losses and credit all incomes and gains. Thirdly, to Nadim account, because Nadim is a personal account and personal account is debit the receiver and credit the giver. Nadim is giving money, so Nadim account is credited 25,000. Being 60% recovered on insolvency, only 60% of the money is recovered on the insolvency. Next, recovered 25,500 from Ahmed, whose account was 45,000, was written off as bad debt last year. Now, it was already written off as bad debt. Whenever you see the word written off as bad debt and now recovered, it is a bad debt recovered account. Whenever you see in your question that it was written off as bad debt and now you're receiving money, means it is bad debt recover account only. So cash account debited 25,500 to bad debts recover account 25,500. Cash account is a real account, so debit what comes in, credit what goes out, and bad debts recover account is a income account or a gain account. Means it belongs to nominal account. Nominal account, the rule is debit all expenses and losses, credit all incomes and gains, being bad debts recovered. Moving ahead, expenses on purchase and sales. Obviously, there are some expenses when we purchase something and we sell something. Expenses means there are little knickknacks. Knickknacks means some few expenses, like when you carry goods to your godam or you download from the truck or you upload to the truck. There are knickknacks, means you give to the person who carries that, means a coolie. Example, a coolie or a man who carries your stuff from the godam to your truck or unloads your or upload or unload your stuff. That person you pay some amount, or you can say the truck person you pay some amount. The person who brings your goods to your showroom, the rickshaw wala, or you can say the cartage, the octroi, everything. So that all things are the knickknacks when we have purchase and sales. So that are also added to the purchase and sale account. So let us study what is written on your sale. Quite often, business incurs expenses on purchase and sales of goods, assets, investments, etc. The account of expense on purchase and sales is given below. Okay, expenses on purchase and sales of goods. So what are the expenses which have during the purchase and sales of goods? A business enterprise may have to incur expenses on purchase of goods. Example, carriage means the person who carries your good from one place to another, that is carriage. Means in the common words we can say rickshaw or we can say auto rickshaw or something like that. Freights. Freights are the some charges which are charged by a person, or we can say a person who carries our goods. Freights are small charges. Cartage means the person who carries our goods. Freights are the small charges. Octroi. Octroi means it's a small charge when we download the some things or we bring things from outside, or we can say outside states. Custom duty. Custom duty means when we buy and sell goods, when we purchase and sell goods from the outside country, we pay a certain amount, that is called as custom duty. Similarly, it may occur in some expenses on sale of goods, salary to salesman, advertisement, etc. So these are also expenses when we sell goods, when we display goods, when we try to display goods to attract customer, we will furniture, we do advertisement, we hire salesmen. So these are the expenses when we do for the sales. For the purchases, we do cartage, carriage, freights, octroi, etc. These are the small charges which are incurred during the purchase. But during the sales, the small charges are salary to salesman, advertisements, or we can construct new furniture for display. That are the expenses for sales. Okay. These purchase account and sales account. Okay, these go under the category of purchase account and sales account. Goods purchase rupees 10,000, cartage on purchase rupees 200. So this is a charge, or cartage on purchase is 200. So purchase account debited 10,000, cartage account debited 200, to cash account 10,200. So purchase account, what is a purchase account? Belongs to, it is a purchase means an expense. So it belongs to the nominal account. So rule of the nominal account is debit all expenses and losses, credit all incomes and gains. So we are debiting the purchase account, or we are writing in a DR. Second one is cartage. Cartage is also an expense. It belongs to nominal account. So we are also debiting the cartage part, that is 200 rupees. And to cash account, cash is a real account. Debit what comes in and credit what goes out. So you're paying an amount of rupees 10,200 to purchase goods. Goods purchase, you're paying an amount of 10,200. Being goods purchase and cartage paid. Being goods purchase and cartage paid. Cartage, carriage, octroi, these are the small items or small knickknacks while you purchase something from the outside business or outside country or outside state, etc. Next transaction, example 2. Goods sold for rupees cash 8,000, sale commission paid rupees 320. Okay. So here we have two different transactions. Cash account debited 8,000, to sales account 8,000, being sales made. The next one is sales commission account debited 320, to cash account 320. Sales commission means when you sell some item, you get some commission from them, and that is called as sales commission. So sales commission paid. Paid means it is an expense. When you pay sales commission, means the salesman have sold something and you pay commission to the salesman. So it is an expense to the business. So it comes under the category of nominal account, means debit all expenses and losses, credit all incomes and gains. So we are debiting the sales commission account. If the sales commission has been received, we will credit it. But if it is given or paid, we are debiting the amount, or we are writing in the debtor part or DR part, not debtor but DR part. To cash account, and we know why cash account, because it is a real account, debit what comes in and credit what goes out. So cash is going outside the business. Next, expenses on purchase of sale of investment and other assets. Okay. Sometimes there are sale and purchase of assets and some investments also. So let us study what it is. Sometimes the expenses are incurred on the purchase of fixed assets and investment. Example, carriage or cartage, installation charges, brokerage, etc. All expenses of the purchase of assets and investment are charged to the relevant asset and investment account. When a particular asset is sold, then everything which belongs to that asset is transferred to that particular asset or investment account. In other words, these expenses are not debited independently with different titles. They act as a charging the debiting the expenses to relevant asset or investment account is called as capitalizing the expenses. So what do we do if there is an purchase of machinery and we have installation of machinery? The machinery has to come to your office, it has to be installed, there are workers working on the machinery. So all these charges you add up and add to the machinery account. You don't debit that given to installation, given to salesman, given to this, given to that. You don't create different subheadings, but you generate everything in one category to that particular asset or to that particular investment account. Example, a machinery is purchased for rupees 50,000, transport expenses rupees 2,000 and installation rupees 3,000 on the machinery. So what do? We add up all the expenses, that is 50,000 plus 3,000 plus 2,000, which comes to an amount of rupees 55,000. So machinery account debited, because machinery is an asset. So it belongs to the real account. Debit what comes in, machinery is coming outside the business, and credit what goes out. Cash is also a real account. Cash is going outside the business. So 55,000 is the amount. So whenever there is expenses made in the business, small expenses like brokerage, installation charges, cartage on freights, cartage, etc., these are added to that particular asset or investment account only. They are not mentioned separately in the books of accounts. So here we have example that we purchase a machinery of 50,000 and we have transportation charges of 2,000 and installation expenses of 3,000. That comes to a total of rupees 55,000. So machinery account debited 55,000 to cash account, as these both are real account. Debit what comes in, credit what goes out. Next, profit and loss on sales. Profit or loss on sales. A business may earn profit or suffer loss on the sale of goods, assets, and investment. Treatment of profit or loss on sales is explained below. Profit or loss of goods on sale of goods. Profit or loss on sale of goods is not declared separately for each transaction. For example, good costing rupees 3,000 was sold for rupees 3,500. So it will be not be mentioned that you have earned profit, and you will not debit the profit account separately, or will not credit the profit account separately. You will not mention the part of profit in your transaction, but instead you will write cash account debited rupees 3,500 to sales account rupees 3,500. Sales being and nominal account, cash being a real account. We wrote the rules: debit what comes in, credit what goes out, and debit all expenses and losses, credit all incomes and gains. Being profit earned for sales. So you do not need to write that 500 rupees is your profit, but you include in your sales. You include the transaction in your sales. You did not need to write separately that you have earned profit in your business, but it can be seen in your books of accounts. Next, profit and loss on the sale of asset. The sale of asset and investment is not credited to sale of asset or investment account. It is transferred to a separate account. For example, now if you're earning profit on goods, it is transferred to the particular goods account, means purchase account or sale account. But it is when it is on asset and investment, it is transferred to a particular separate account. Example, furniture costing rupees 18,000 was sold as 15,000. So 18,000 minus 15,000, there is a loss of 3,000 rupees. So we write the transaction as follows: cash account debited rupees 15,000, loss on sale of furniture account debited 3,000, to furniture account 18,000, being furniture sold on loss. So why? Because the sale of assets and investment we write in a particular subheading, particular separate subheading, but sale and purchase of goods or sale of goods we write in the good or purchase or sale part itself. Next is loan taken and loan advances. What is loan taken and loan advances? Loan transactions are very common in the business. Loan taken by the person is a liability as the rule. Increase in liability is always credited. When a loan is given by the business, it is treated as an asset. As per the rule, increase in asset is always debited. Increase in liability is always credited. Increase in asset is always debited. Remember these two things. Increase in liability, it is a credit, it's always credited, and increase in asset is always debited. In order to make a distinction between the loan taken and loan advances, proper title PF of account should be used. When the loan lended, bank loan account, Ashika loan account, but when a loan is given to others, loan word should be used before the name of the borrower. Example, loan to Thomas account, or proper title of the advance account. So when the loan is taken, we need to mention bank loan account, Ahika loan account. But when the loan is given to the outside party, or the party is outside the business or to others, we can write, we should write the loan, the word loan in front of the borrower. Means loan to Thomas, loan to XYZ, loan to some person, loan to Sabha, etc. But when we are receiving loan or we are taking loan, we can write Sabha's loan account. But when we are giving loan, loan to Sabha. There's a difference between the two. When we are taking loan, we'll write Sabha's loan account. When we are giving loan, loan to Sabha. There is a difference between the two. Example, borrowed rupees 10,000 from Jennifer. So we have borrowed rupees 10,000 from Jennifer. So entry will be cash account debited rupees 10,000 to Jennifer's account. As we have borrowed, we have taken. So we'll write Jennifer's account being borrowed from Jennifer. Example 2, lent rupees 15,000 to Sanya. We have given to Sanya. So the difference is loan to Sanya account debited to cash account. So it is the reverse of the first entry. Second entry, we are writing loan to Sanya. The first entry, Jennifer's account or Jennifer's loan account, whatever you can write. But the second entry is loan to Sanya because we are giving money. So that's all for today's class. We'll continue this class in the next video or the next coming video. Thank you, everyone.